Hi, it's Tammy Campbell with the Impakt Realty Group, brokered by Keller Realty. And today I'd like to talk to you a little bit about the importance of getting yourself pre-qualified or even pre-approved prior to shopping for a house. I know that it can be really exciting thinking about changing your address and looking at homes that have all the features that you think are great and they're in great neighborhoods. But if you don't know what you can afford, it's not really a good use of your time to look at a home that perhaps doesn't fall within your range. I know that there are people who are intimidated by digging into their financials, whether it's having to get those tax returns together and those check stubs together, and it sounds like a lot of work. I might not even like the house. However, these are things that are absolutely essential in order for you to make sure you're shopping for a house that you can afford. So if you want to dive into it before talking to a mortgage lender, you can get your credit score from Experian.com. They are one of the 3 big credit bureau agencies that report to the mortgage lenders. You can get an annual report for free. This will give you an idea of where that number's at. And that number can range from 800 to perfection. Some people don't even have credit scores because they've never had a loan or they've never had a credit card. So the credit unions have nothing, or the credit bureaus have no information on them at all. So they have to establish credit, and that can be done easily enough in simple ways that your mortgage lender can give you very specifics for. But a lot of people will just open up a secured credit card, use that credit card for maybe buying gas, pay it off every month, because the rate at which you pay your bills, meaning timely, consistently, on an ongoing manner, that defines how good your credit score is. Now, the other thing that you could take a look at is debt to income. Many lenders want your debt to income after buying the house to be about 43%. So let's just say that you make $60,000 a year. Right now you've got a car payment and you've got a credit card payment. So really you've got less than 20% of your take-home pay is going towards those 2 debts. But once you have a house, let's say you buy a house that's $215,000 at interest rate 6.25%, 3.5% down, you're going to have an $1,800 monthly mortgage payment. Now let's add that to your student loan payment and your car payment, and now that's the total that they're going to measure against $6,000. And the example that I just gave you with that $1,800 payment, plus I think I was using a number of around $500 for a car payment and then a credit card payment, the numbers came in right out about 39%. That's a perfect guideline for you then to say, okay, well, what kind of house fits into this payment at $1,800? In this example, it's a $215,000 house. So those are some things that you could work through on your own. And if you want to talk to me about that, I would be happy to help you identify those numbers. So that way, when you sit with this mortgage professional, you aren't caught off guard about what they're looking for, and you actually have had a chance to run some numbers on your own. Getting pre-approved, getting pre-qualified are an essential piece of changing your address. This is Tammy Campbell. Call me with any questions.